Now, you thought bonds were safe, stocks were maybe a little riskier, gold and silver, they were, I don't know, crazy alternatives, barbarous relics. Bitcoin, that was a lottery ticket. Well, it might be time to rethink some of those old stereotypes. Gold is near an all-time high, up 66% over the past 19 months. Silver, it's at a 14-year high. The NASDAQ, the S&P 500, they just hit new records. Bitcoin is up, ETH is up, everything is up. And maybe that feels good and maybe it feels off. We don't have to pretend here that this matches up with the actual economy or the actual expansion of personal wealth because we all know it doesn't. But we can look past the signals, we can see a shift here. And then one possibility is that these gains aren't simply about the assets getting stronger. Some of it's maybe the dollar getting weaker. Well, no surprise there. But if all of these assets have to run just to keep pace with the falling dollar, what should we actually be holding long term? Because the asset mix that worked for the last 40 years probably isn't the one that will work for the next 20. And if you're into alternative assets, gold or silver in particular, well, you should check out channel sponsor Summit Metals. Gold, silver, even platinum, they have it all. Check them out at summitmetals.com. So let's start with a quick look at the dollar. China has cut its U.S. Treasury holdings to the lowest levels since 2009. They used to hold over $1.3 trillion. Now they're down to $756 billion. That's third place behind Japan and the UK. And it's a big drop in confidence. And this isn't just China. The US is running massive deficits. I'm sure we're all aware. And the demand for treasuries just doesn't keep pace with that. The Fed doesn't really have any more levers to pull. So the US is going to need some new tricks to turn things around for the dollar. Now, this is where we're seeing talk about stable coins making the dollar more useful and why we're seeing more attention given to alternative assets like gold and crypto. So that's the simple setup for all of this. Alternative assets are getting more attention. Gold is getting more attention, and not just more attention, but also a different kind of attention. We're looking at a shift here. You or I, we might have always had gold in our portfolio to some extent, but it probably represented a little bit of an alternative to the typical. Well, what I'm covering here is how that might be changing, how it might be losing that alternative label. And to really get into that, we need to cover some of the changes that we're seeing right now. Let's talk about stable coins first. Now, the usual suspects, they're out on the fear circuit. They're telling us stable coins are the new CBDC. So let's start by clearing up all that misinformation. First, we were told the CBDC was going to lead to a reset. It was going to slurp away all of our money. Then we were told it was Fed now. Now, that was the game changer. That was going to be the CBDC that ended everything. Well, now it's stable coins. And all of this is just doom speak. People trying to manipulate you to get you to buy what they're selling. Now, there is a lot happening with stable coins. Let's just do a quick rundown. The Genius Act, that was just signed into law by Trump. It creates a regulatory framework for stable coins, gives backing requirements. The Clarity Act, that was just sent to the Senate. That transfers jurisdiction over digital assets from the SEC to the CFTC, and it lays out rules for exchanges and brokers. And then the CBDC Anti-Surveillance State Act that was just passed by the House. This one is more important to me. It prohibits the Fed from issuing a central bank digital currency without congressional approval. Now, just for the record, though, that just reiterates the existing case. Really boring stuff as far as I'm concerned, but that's the backdrop for a lot of these fear stories. I just want to make sure we all know what's going on. So all of this is really pretty simple. What it means is that we're going to see more players issuing stablecoins. They're going to be backed by actual US dollars, and there's going to be a regulatory framework behind them. So faster transfers, more access, less friction. It's basically a set of new tools that would hypothetically make the US dollar easier to use without giving up your privacy. These are not digital dollars that lead to some kind of wealth transfer, some kind of global reset, but apparently there are going to be people out there trying to tell you they are. So what does this mean for the quote-unquote alternative assets? Well, they're already in the spotlight with all these new all-time highs, gold, silver, Bitcoin, Ethereum, whatever you like. Gold has locked in its safe haven appeal. Bitcoin, it's locked in its, gambling appeal. But what does it mean for our portfolios? Well, like I mentioned earlier, the asset mix that worked for decades, stocks, bonds, and cash, just really isn't relevant anymore. You have inflation, debt, weakening dollar. All of these are pushing investors to rethink how much gold, silver, crypto, and cash should be in their portfolios. Now, before we get into this idea of gold no longer being an alternative to a standard portfolio, well, we need to look at its historical performance, and we probably shouldn't expect much from it. But here we are. We can see gold actually leads silver, the NASDAQ, and the S&P 500. Even when we look at dividends being reinvested, this chart shows that since the year 2000, gold is at 1,075%, silver's at 617, and the indexes are right around 300%, give or take, 562% when we consider dividends. Now, that doesn't seem like a wild place to store your savings. Well, since 2020, maybe it's a little bit tighter. Gold would be at 126%, silver at 120%, total market with dividends, 115%. So again, gold has come out on top. We all know crypto has been doing really well also. So there shouldn't be any big question about whether alternative assets have potential, and I wouldn't recommend doing away with what's already working for you or even that stocks are a bad idea, but this is more about allocations. Now, we aren't the only people noticing this. There's some big news coming for retirement accounts that's relevant here. President Trump is preparing an executive order that would open up the $9 trillion U.S. retirement market to alternative assets like crypto, gold, and private equity. That's one way to look at it. The other is that it would just be easier for you to have in your retirement account. Now, this is a bigger shift than it might seem, since big pension funds would now have direct access to assets that had to be purchased and managed in other ways up until now. Basically, it makes it easier to directly hold gold or Bitcoin in a retirement account, in any retirement account. Maybe it's yours, and that would be without any additional hoops. Now, as somebody who's never had a significant position in bonds, this shift seems pretty obvious, almost expected. It surprises me that the old 60-40 portfolio model is still even suggested. That's 60% for stocks, 40% for bonds. Now, we don't have to look real hard for a case where that really doesn't make sense. Just look at 2022. Both stocks and bonds fell hard. And in a case where bonds hope to make 4 or 4.4% and inflation is running around 2.7, well, that leaves about 1 to 2%, and that's if things go well. So with 40% or more of a portfolio returning just 1 to 2% after inflation, well, that old model doesn't leave much of a safety net. And if you're following that 100 minus your age rule, you could be pushing even more into bonds as you get older. I'm not sure that holds up anymore. Gold is up 28% year to date, up 28% last year. Compare that to 4.4% for bonds. So 60-40 or 100 minus your age seems like a model built for a different world, a world without this much debt, without this much currency risk, and without alternatives that are performing exponentially better. So let me just say it again. I'm not qualified to give financial advice. This isn't meant to be that. I'm just looking at the statistics and these new policies that are being pushed to allow new assets into traditional retirement accounts. I'm also looking at U.S. deficits and inflation, the falling dollar value, and the consistent outperformance from other assets. Bonds, they're just falling further and further behind. So big inevitable shift, not really one that's going to affect my personal allocations because I never really relied on bonds, but one that could affect all of us, whether you've been into bonds or not, as new capital flows into these previously considered alternative assets. Now, what happens when the big pension funds pour into gold and Bitcoin? Well, the prices go up even more, the assets perform even better. More reason for a bigger shift. So let's call it good there. Let us know what you think of these old 60-40 type models, stocks and bonds. Do they still work? Have you changed your own allocations? Let us know. And then while you're in the comments, be sure to hit that like button if you found any of this interesting. Be sure you're subscribed with notifications turned on if you want to hear more on the topic. And if you're still here, thanks again for watching. I always appreciate your time. Take care.